Okay, so for today's class, okay, what we are going to look into will be on topic 10, okay, which is on the capital budgeting. So in this topic itself, it can be divided into two parts. The first part is you are going to learn four different decision rules. Okay, so that's the first part. Okay, and second part is basically where you'll be given a scenario in which you are going to compute the NPV of the project to see if it's profitable to proceed or not. Okay, so as usual, this topic carries another 20 marks in the finals as well. Okay, so now what we're going to look into will be to look into the first part of this topic first, which are the four decision rules. Now, let's have a look into the first two rules first. I will go through the rules with you, and then at the same time, we will refer to the tutorial question at the same time to show that how the rules work. All right. Now let's have a look into the first one. The first rule is called payback. Payback period. Payback period basically saying that we want to see how quickly, okay, we can recover the cost back from the investment itself. So how quickly the initial investment is recovered. So the lower the payback value, that means what? The shorter the time that you need to actually cover back all the costs that you have pumped in for the investments. So of course, the lower, the better. Okay. Now, and the rule that we learned before is called NPV, net present value. Okay, so it basically looks into a difference between the market value of a project and its cost. So same thing as well, when you calculate NPV, you discount back all the future cash flow back to the present value to compute the net present value. We are not going to use the formula methods. We are going to use the financial calculator methods in order for you to derive the NPV itself. Okay. Now, so as long as your NPV is larger than 0, we accept the project. Okay, when it is larger than 0 means what? Means that the inflow is higher than the cost. Okay, the value of the project is higher than the cost, and therefore it is profitable to do so. Now, let's have a look into the questions and see how these two rules are being applied. First one, this company itself, okay, impose a payback cutoff of 3 years for its international investment projects. If the company has the following two projects available, should it accept either of them? Okay, that's the first question. Second question, calculate the NPV of the project if the required rate of return is 10%. Which project should we accept if both projects are mutually exclusive and independent? So again, later we will talk about how will your decision change when refer to mutually exclusive situation and independent situation. So you are being given with two projects over here, project A and project B. Okay, so these are the cash flow that you will incur. Like you see, in year 0, it is the present year. In present year, okay, you will incur negative sign. Why is that a negative sign in year 0? Because these are the money that you pump in to invest. So cash outflow. Okay, so remember later when you key in into your calculator, let's say if you were to calculate NPV, your year 0, the cash flow in year 0, there is a value, and do not forget the negative sign. Then after that, in the following years, you will receive the cash flow that's being generated by the investments. So now let's have a look into the first question, which is to calculate the payback. So how do we calculate the payback? So for example, let's have a look into project A. So you see project A itself, at first, you spend 45,000 to this investment. We want to see how fast this 45,000 is being recouped back. Okay, so you see in year 1, you receive 17,000. In year 2, you receive 23,000. So when you add this up, almost there already. You got 40,000 getting back already in year 2. So you see 45,000 in total, you only left with 5,000, right? So in year 3, 5,000 out of the 19,000 that you will receive in year 3, okay, plus the 2. Where do I get these 2? The 2 are basically the cash flow that I received in year 1 and year 2, because now I'm calculating the period. So therefore, I'm aware that now I will need to wait for 2 years okay, plus another few months in year 3. But how do I know how much is the few months? I use the 5,000 divided by 19,000, and at the end, I got 2.26 years. So that means project A, I will need 2.26 years in order for me to get back the investment cost. Okay, now let's have a look into another example. Project B. Okay, project B over here, you spend how much? 90,000. Okay, you spend 90,000 in the year 0 in order to pump into this investment itself. So let's see how long do you need to cover this 90,000 back. So you see, in year 1, you receive 19,000. In year 2, you receive 24,000. In year 3, you receive 35,000. Almost there already. You see, when you add up these first 3 years of cash flow, it's already giving you 78,000. Okay, now left a bit more, right? Because now you need to have 90,000 in total. So you still have 12,000 more. So how long do you need to wait more in year 4? So you see, you use 12,000 divided by 55,000. Okay, plus we are aware that the first 3 years we need to wait already. So at the end, you add this up together, you get 3.22 years. So that means that project B will take 3.22 years for you to cover back the investment cost. So therefore, for payback period, the shorter the better. So in this scenario, which one do you proceed? You proceed with project A because project A use shorter time, okay, in order to basically recoup the investment cost. And do not forget, they already give you in the question, cut off of 3 years. So you must actually within 3 years, you want the money back within 3 years. So only project A can fulfill that. Okay, so therefore that's how you got the answers over here. Okay, now let's move on to next question, which is on NPV. Now, of course, there will be some limitations in terms of using this payback period. Like for example, you see, payback period only focus about how fast you can recoup the investment cost. It looks into how short the period you use in order to recoup back the investment. So therefore, it will be a bit biased because some investments, right? Especially like those research and developments or innovations, right? It will usually generate even higher returns in the subsequent years after you cover all the investment costs. So you see, payback period does not recognize all the positive cash flows in the upcoming years. Therefore, it results in biasness actually. And also for payback period, right, it's very arbitrary. Here it says that you want to look for an investment with a cut-off rate of 3 years. And how do you come up with these 3 years? It is random. So do you realize that how many problems with this payback period? Those are what we call as the disadvantages of the payback period itself. So by referring to the decision rule of payback period, it is insufficient. Okay, so therefore we need to look for another one, which is on NPV. Okay, so that basically leads me to the second question on NPV. Okay, now still the same question, but now we are going to use the financial calculators to calculate the NPV for that true investment itself. So now let's do it together. So first, let's do project A first. Okay, so project A, okay, now first of all, second, reset, enter. Okay, now the difference this time is that you have a value in year 0. Okay, so now we are going to use the cash flow function. Okay, cash flow function. Okay, now in year 0, okay, CF0, you have some values. Okay, so let me write here. Okay, CF0. Okay, for project A, okay, you got you pay 45,000. 5,000. Okay, remember to put a negative sign. Now, C01, okay, C01 is how much? C01 in year 1, you receive 17,000. Okay, 17,000. Then how many times you receive this cash flow? You receive 1 time. The frequency is 1. Okay, C02, okay, C02 is 23,000. Okay, how many times you receive this? Again, it is 1. Okay, you receive 1 time as well. Okay, now C03, okay, cash flow in year 3, you receive 19,000. And how many times you receive this? Frequency is also 1. C04, the cash flow you receive in year 4. Okay, how much you receive? 100,000. And frequency is also 1. Okay, now what's next? You press NPV. Okay, they ask you how much is the I. The I is 10%. You key in I, 10, and then enter. Okay, enter going down, compute NPV. Okay, and straight away you get the answer, which is 72,039.14. So NPV is larger than 0. Good to proceed. But again, we still want to do comparison between these two investments first. So that's what you need to write when it comes to exam. Okay. So you key in all the cash flow that you receive in every year, and the frequency is 1 in this scenario. And at the end, you calculate NPV. What's the difference between this NPV and the previous NPV that we did is that here in year 0, you paid an amount over here. Okay, a negative 45,000 is your investment cost. All right, so same thing as well. This is for project A, and you do the same for project B as well. So using the financial calculators to derive the NPV for project B. So therefore, you have one for project A and one for project B, and then you do comparison. So of course, you choose the one, the higher, the better. But we don't make the decision first, because this question, there'll be a tricky part, because they'll ask you, what if the scenario is mutually exclusive and what is independent? Okay, what if it's mutually exclusive and what if it is independent? So different scenarios will result in different decisions being made. Okay, so in exam, there'll be one question asking you, what if the scenario is mutually exclusive and what if it's independent? So let me tell you how the results will vary. Okay, so first of all, when I say mutually exclusive means that like what you learn in probability, both events will not happen together. So I give you an example. When you flip a coin, it's either you get a head or a tail. You will get both, or you wouldn't get in between. Okay, so both events will not happen together. Or like I give you an example, it's either you study at Taylor's or you study at Sunway, but you cannot study at both places. So that's why I call it mutually exclusive. So if it's mutually exclusive, means that we cannot have two of these events happen together. That means you can only choose one. So you choose the one with the highest value. Which is the one with highest value? Project A. Okay, project A is the one with the highest value. Okay, so remember, there will be one question asking you mutually exclusive. Now, moving on to the next one. What if it is independent? Now, you see, when you learn maths, the probabilities, right? You know, these two concepts are always a confusing one, because you thought that, mutually exclusive seems like a bit like independent, but it's not true. Just now, mutually exclusive, we say both events will not happen together. But independent means that the occurrence of one event will not affect or will not depend on another event. So that means these two events, they both are not related, but they can happen both at the same time. They are both unrelated, but they can happen. Okay, of course, if you learn probabilities, there is one equation. Remember, you learn about conditional probabilities. Probability of A given the conditional of B, like that's what you learn in maths, and then at the end you found the independence one. So independent means both of the occurrence can happen, but the occurrence of one event will not impact the others or will not depend on the other event. So that means both can happen together. So if it's independent, both you can proceed. Okay, so project A and project B can be proceeded. Okay, so this is one of the important rules that you must remember. So if you compare between payback and NPV, the first two rules, right? Which one is better? Of course, it's NPV. Now, why is NPV is better? Because first of all, NPV takes into account of the time value of money. Remember, when you key in your NPV, you key in the I. The I basically is what we call as the one of the rate of return that you take into account, which take into account of the time value of money. Unlike payback period doesn't even recognize into all this. Okay, so that basically looks into the next part over here, which is to look into the advantages and disadvantages of the payback period. So you see, payback period is easy to understand, easy to calculate. It's a very good supplementary information, but the problem is first, it ignores time value of money. Now, what is time value of money? Like, for example, we learned about this term a long time ago when we say that, like today, the 1000 carries more of value as compared to the future. Okay, so therefore, that means is links to the idea of inflation. So payback period doesn't even take into account of all this at all. I just focus about how fast I can recoup my investment cost back. So it is not taking into account of time value of money. And the cutoff period is very random. 3 years. How do you come up with these 3 years? It's very random, arbitrary. Okay, and it does not take into account the cash flow that you receive in the upcoming years after the investment is being recouped. That's the problem. Okay, because when it comes to some research projects, it generates high cash flows after you recoup that cost. But all these have been ignored. Okay, so at the end, we use NPV. NPV should be the main criteria for decision making. Now, let's move on to the next one, which is the third decision rule. The third decision rule over here, it looks into average accounting return. Okay, so what is average accounting return? Again, let's go through the rules first. It basically looks into the average project earnings divided by the average book value of the investment during its life. So again, if AAR is larger than cutoff rate, we accept. Okay, so that means we have average project earning. Okay, we have the average net income from the project itself on my numerator and the average book value at my denominator. So how do we calculate average book value? You use the beginning book value plus the ending book value divided by 2. So like for example, let's have a look into the first scenario over here. You are trying to determine whether or not to expand your business by building a new manufacturing plant. The plant has an installation cost of 17 million, which will be depreciated straight line to 0 over its 4 years life. If the plant has projected net income of this amount, this amount, this amount, and this amount over here over the 4 years, what is the project average accounting return, AAR? So first of all, as I say, remember the formula. Okay, I want you to remember the formula first so that you will never get a mistake. AAR formula is average net income divided by average book value. So to get average net income, I'm aware that my project will generate the returns of the net income of the 4 values that you can see over here. Yeah, the 4 values over here. So I want to calculate the average. So I need to add all this thing up. Okay, add all these things up divided by 4. Why do I divide by 4? Because I have 4 years over here. These are the 4 years return from the project itself. So I add this up and divide by 4 and I get this amount, which is the average net income. Okay, now after that, I will calculate my average book value. What is my initial installation cost? 17 million. And depreciated to how much? 0. So that's the ending book value. So I have the beginning book value and the ending book value. So I add this up together, divided by 2, and that's what we call as average book value. When I use these two divide by each other, at the end, I get the final answers. And as long as my final answers is larger than the cutoff rate, then we should proceed. However, in this question, the question does not give you. But here, let's say we assume that the cutoff rate is 25%. But how much do you got in terms of AR? It's only 20.96%. So 20.96% is lower than 25%. So therefore, we should reject the project. Again, what do you think about the effectiveness of using this rule? Again, is arbitrary. How do you come up with this 25% in the first place? Right? It is random. Again, this is not a good rule as well. Okay, so that's how you argue. Okay, so therefore, okay, what's next is once you are able to get the answers, now we move on to the advantages and disadvantages, okay, which is the pros and cons of the AAR. So again, it's easy to calculate because you just use the formula itself and you get the answers. Again, it's a good supplementary information, but the bad thing is, again, it doesn't take into account of time value of money, unlike NPV, okay? And it is very random. How do you come up with the cut-off rate? Okay, so one more thing also is that just now we looked into it in terms of book value, not market value. So it's actually quite inaccurate as well. Okay, so therefore, these are the pros and cons of AAR. Okay, now moving on to the next rule, which is on the IRR. Okay, now think about IRR as a rate of return, you know, like your rate of return in the form of percentage. Okay, so the IRR means that annual rate, okay, the annual rate of growth that an investment is expected to generate. Okay, so therefore the IRR over here, okay, basically it's like the rate of growth that we expect from the investment itself. Okay, now if IRR is larger or equal to required rate of return, we accept. Okay, because when your IRR is larger than the required rate of return, that means your NPV will definitely be larger than zero. Because we definitely want NPV larger than zero. Because if IRR is lower than the required rate of return, then that means the NPV is less than zero. That means there's no point to accept a project that does not carry a high inflow as compared to the cost. Okay, so we only accept the project if the IRR is larger than the required rate of return, in which the NPV will definitely be larger than zero. Okay, so therefore, for example, let's have a look into this scenario. Again, do we need to use any manual calculations? No. So remember for NPV and IRR, you do not need to use the manual methods, but you use the financial calculators. So a firm evaluates all of its projects by applying the IRR rule. If the required return is 13%, should the firm accept the following project? Okay, so 13%. Okay, again, same thing. Now you are being given this cash flow. At first, you can see that what's the difference of today's class is in year 0, you spend money. So in year 0, there will be a negative cash flow. So therefore, when you key into your financial calculator, what you should remember? You should remember to key in the CF0 with a negative sign. Okay, so yeah, so therefore, same thing as well. Okay, press second, reset, enter. Okay, again, let's go for cash flow functions. Okay, now CF0 equals the same thing as well, 4,550, and remember to key in the negative sign. Okay, C01, you try the cash flow function first. Later we press IRR. Okay, C01 in cash flow in year 1, you receive how much? 1750. Now 1750, and how many times you receive this cash flow is only one time, so it equals to 1 as well. And after that, C02 is how much? 2550, and the frequency is equals to 1. Okay. Then cash flow in year 3 is 540. Okay. Frequency in year 3 equals to 1. Okay, then after that, you press IRR. That's a new method that we learned today. You press IRR. Okay, then you should press compute. Okay, IRR, and then press to compute. Basically, it compute I for you. Okay, straight away, you generate the I, which is the internal rate of return to you, which is 3.61%. Now, how much are we expecting in this scenario? 13. Okay, 13. But how much are you generating here? 3.61%. Should we proceed? We should not. So we should reject the project. So you see, among these 4 rules that we learned, we say that payback is not so good, AAR is not so good, NPV okay. What about IRR? Why not okay? No, no. Why is that this rule not the best rule for us to use? Okay, so therefore that comes to our disadvantages of IRR. Okay, so therefore now we move on to the next one. Okay, IRR is unreliable in certain conditions. First one is non-conventional cash flow and mutually exclusive projects. Again, mutually exclusive project means you only can choose one. If you can only choose one, you better use NPV, that will be more accurate. Second is non-conventional cash flow means you look into this one, you see that first in year 0, you get negative cash flow, right? Because you paid money. But following year, you get positive, right? So every year you receive positive cash flow. But it's not always the case. In real life, that could be in certain years, your cash flow is negative. If you have a cash flow, if in the negative, IRR cannot be used anymore. So it will be inaccurate already. So IRR is not good as well. So which one is the best? NPV. So therefore, when you are being presented with different investments and being asked to compute with different rules in exam, at the end, which decision, when you make the decision, you follow the one with the NPV, with the highest NPV. Follow the NPV. So NPV is the one that you've used as the main criteria for your decision making. Okay. So these are the 4 decision rules. Okay. Now let's come to part 2. Part 2 is basically going a bit deeper by evaluating a project given a scenario in order for you to compute NPV. So therefore, when you are being given a scenario, you are going to try to calculate the cash flow for each year first, and then to put all this cash flow into the calculator to compute your NPV. The way of how you calculate NPV is the same, but what is different here is they won't tell you the cash flow in each year. You do yourself. You draft the table, you calculate the cash flow that you will spend and you will receive in every year, and then for you to calculate NPV. When we learned this just now in question number 2, did we calculate the cash flow by ourselves? No. They give us the table and say year 0 you spend what, year 1 you get what, year 2 you get what, year 3 you get what, right? But now no, you do everything by yourself. So therefore, few things that we want to take into account of when we calculate the cash flow first. First, we take into account of initial costs, the spending, okay, the investment spending. Then followed by depreciation tax shield. What is depreciation tax shield? Shield is like protection, right? Okay, so therefore, depreciation tax shield means that the tax saving part, you know, like those amount that you save from taxes, okay, because of recording the depreciation expense. Depreciation is an expense that is tax deductible. So when you record your depreciation expense, okay, what happened is it will reduce the amount of tax you have to pay. So this is like a tax saving from depreciation. So we call it as depreciation tax shield. Is it a good thing? You save money, so it's positive. Okay, remember, so remember the sign. You remember the sign first, or else once you get it wrong, the whole thing will be gone. Now, the next one is salvage value after tax. What is salvage value? Salvage value means residual value. That means today, after you sell off an asset, at the end of its life, you get some residual value. But of course, when you talk about residual value means you earn something, right? You still have to pay taxes as well. So we need to adjust for taxes. Okay, so you receive the salvage value minus tax rate bracket S minus B. Why? Why do we need to do that? Because I need to minus the taxes that I pay for this salvage value. So this is the formula for salvage value after tax. So basically, are you earning something from here? You are. You're still earning something. So you're earning something, then it is positive. Okay. Next one, cost saving. When you invest in a project, definitely you will, you can save some costs. Okay, cost saving, but not always the case. Sometimes, maybe you do not save some cost. Maybe the investment does not go well as you expected. But if you really save some cost, is it a good thing for you? So it's a positive sign. But if it is not, it does not result in cost saving, then it's a negative sign. This is very tricky. This is the one a bit tricky. Okay. Now, revenue after tax. Okay, again, you earn your revenue and then you adjust for tax. So therefore, revenue bracket 1 minus tax rate. That's at the end the money that you earn after tax, right? So is the inflow coming into your business positive? Okay. And lastly, your net working capital. Net working capital. What is net working capital again? The money that you use to pay for your day-to-day expenses. So in year 0, of course, you pay money going out. Okay. Then after that, at the end, you will recoup back. So beginning will be negative, at the end will be positive. Okay. Then we run by using calculators. Okay. Let me show you the question. Okay. Now, so based on the first part of tutorial, overall, we can summarize the 4 decision rules is this one. You can take this acceleration, okay, in the answers. Now, let's look into part 2. I want you to look into this one over here. AgroFoods is looking at a new social system with an install cost of this amount. This cost will depreciated straight line to 0 over the project's 5 years life. Depreciated to how much? To 0 over the 5 years life, at the end of which the social system can be scrapped off for how much? This one. So what value is this? Savage value. The social system will save the firm this amount. Save the firm this amount per year in pre-tax operating costs. So can someone tell me what kind of value is this? Cost saving, very good. Okay, so this is cost saving, but it is pre-tax, before tax. So later, when we want to put into our calculations, we must adjust for taxes. Okay, and the system requires an initial investment in net working capital of 41,000. So 41,000 here is what? Net working capital. So 41,000 in year 0, should it be positive or negative? Negative. In last year, positive. Okay, remember this. Then if the tax rate is 34% and the discount rate is 8%, what is the NPV? So how long in total is this project last? 5, right? 5. So you can draw a table. Year 0 here and year 5 here. Okay, year 5 on the last column. In between year 1 to year 4, the numbers will be the same usually. Okay, so first one, you put your system cost. How much you pay for this installation cost is negative 625,000. Okay, got it. Now, depreciation tax shield. I want to see, how much of tax being saved from depreciation itself. So therefore, how? So I will use this installation cost. Okay. Now, because it is depreciated straight line to 0 over 5 years life. So I shall use 625,000 divided by 5 times the tax rate. How much is the tax rate? 34%. Then I get this 42,500. It means what? It means every year the firm is saving 42,500 from year 1 to year 5 from this depreciation tax shield. That means that tax saving by reporting the depreciation expense. So what sign is this? Positive or negative? Positive. Okay. Next one, remember we sell off one asset here. Is scrapped for 95,000. So salvage value, but that is before tax. I need to adjust for tax. Minus tax rate, bracket, salvage value, minus the book value. Okay. Now, what is the book value then? Okay. Now you see, this one over here, we know that when we scrap off is 95,000, that's a salvage value. Okay. And minus 34%. And then salvage value is 95,000. But what about book value? Okay. Book value over here, because remember I say that this investment over here, this asset over here, depreciated straight line to 0. So it's 0. Okay. So at the end, you get this 62,700. But should you record in every year or in only last year? Because after tax salvage value means you only get the value after you sell off the asset, after you scrap off. So it's only recorded in last year, in year 5, in a positive figure. Now, after tax cost saving, so same thing, it says that 183,000, adjust for tax, you get this amount. This is the cost saving for every year from year 1 to year 5. Okay, and net working capital, negative 41,000 in year 0, positive 41,000 in last year. Now, gao-dim everything already actually. So I want you to see one thing over here. So focus on the table on the top. Okay, now the bottom over here, I do not want you to see because we are going to use a financial calculator approach in order for us to be able to derive the answers. So therefore, we ignore all this first. Now, actually, by looking into the upper part, you have already gotten the cash flow for each year. In year 0, you spend 666,000 over here because you add this up, negative 625,000 plus another negative 41,000. So that is a total negative value over here. Year 1 to year 4, you receive this value, and year 5, you receive this value. So therefore, what you need to do now is you have already computed all the cash flow yourself, and you just do that the same. Okay, so therefore put everything into the financial calculators. At the end, you key in CF0, negative 666,000, C01, you receive this amount. But how much is your F01? How many times you receive this amount? Year 1 to year 4, how many times? 4. So F01 is 4. Okay, C02, the last one, and then F02 is 1. So NPV, okay, and then interest rate is 8%. Okay, because the discount rate is 8% here, as stated in the question. Okay, and compute NPV. Okay, so therefore you get the answers. Okay, so that's how you calculate NPV using basically using all the information that have been given to you. Okay, so NPV larger than 0, should we accept? Yes, we should accept the project. Okay, now last question. Again, you are considering buying a new machine which will last for 5-year period. Again, later on, year 0 to year 5. Okay, and will be sold at the end of 5 years. The new machine will cost this amount. Okay, revenue from the machine is this amount a year for the 5-year life. Okay, the annual cost of running the machine is expected to be 15% of the revenue. Annual cost, 15% of the revenue. Okay, excluding wages and admin costs. The annual wages expense is 2009. Okay, this annual wage expense. And admin cost is this amount per annum. Per annum means every year. Additional inventory at the start amount is 2240. Now, additional inventory, this amount. Can you tell me what value is this? This is something that you will spend in the beginning, but at the end recoup back in the year 5. I do not use the word like just now. Net working capital, correct. Okay, so do you realize that I didn't use the word net working capital over here? Okay, so there's net working capital. Depreciation is 20% per annum, straight line to 0. Again, to 0 over the 5 years. Salvage value of the machine is estimated to be 15,000 at the end of 5 years. Required rate of return is 12% and tax rate is 30%. What is the NPV? Same thing. Do the calculation here. First, you pay for the new machine. In year 0, this is the amount that you incurred, that you spent. Okay, then calculate your depreciation tax shield. 30,000 minus 0 divided by 5 times the 30%. It's 1,008. Now, what does this 1,008 mean over here? That means it's the cost, the tax saving for every year from year 1 to year 5. Then calculate after tax salvage value as usual as well. At the end, you get this amount. But remember, you only record this in which year? Year 5. Okay. Now you have after-tax revenue as well. So they give you revenue, but it's not adjusted for tax. So you need to adjust the tax by yourself. 19,500 adjust for tax is this amount. And this is the revenue that we receive after tax every year from year 1 to year 5. Okay. Now remember we talked about the cost as well. The cost of running the machine is expected to be 15% of the revenue. In this case, most likely we are not having cost saving already, because it is expected to be 15% of revenue is the annual cost. Okay, so you use 15% times the 19,500, adjust for tax is this amount. So it's not a cost saving, this scenario. This is a negative figure. It's a negative figure from year 1 to year 5. Now you have your wages 2009 and admin cost at this amount, but you cannot straight away write 2009 and 7,002. Why? Why? Now I know these two are my expenses. I know both are negative and I incur all this in every year from year 1 to year 5, but I cannot just key in all these numbers into the table because I will need to adjust for tax. Correct. So adjust for tax is 2030 for wages and 5040 is admin expense. Okay, and lastly, inventory is my working capital. Year 0, you put negative, and year 5, you get positive. At the end, you total up the cash flow for each year and put that into calculators and compute NPV. At the end, you realize that this project will generate a negative returns. So my question for you here is this: should you still proceed? No, and why? Because it's a loss, exactly. So you should reject the project. Okay. So that basically is the part 2 of the topic 10 itself. Okay. So that's the thing that you need to know for the entire topic of topic 10. Okay.